Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is Steve Meisinger, your host for today's ISE webinar. I'm the Director of Education at the International Securities Exchange, and each and every week we have webinars where we bring on special guests, whether they are FX or even ETFs. That's our new series. So today, I'm pleased that we have Nicole Wachs with us. Nicole's an options analyst and Director of Education at TradeKing. She's a former market maker, so she really understands options better than most. And she'll be talking about using butterfly spreads and their versatility with FX options. Nicole, thanks for joining us at the ISE. Nicole Wachs, thanks so much.
Thanks very much, Steve. It's great to be here. Welcome, everyone. Thank you for having me with you today. I just want to make sure that people can see the slides changing as I'm clicking through.
Not right now, Nicole. I don't see them changing. I just might have, try again. I just gave you the ball. Let me try to change and then bring it back. Let's see. All right. I am now the presenter. Now I'm going to try to make you the presenter. Passing. Okay, try it again, Nicole. Nicole, are you there?
I'm here. I'm advancing. Oh, there it goes. It was just a delay. All right. I think that did it.
I'm not certain. I don't think anybody else. Oh, there you go. Okay.
All right.
Perfect. Okay, good. We're good to go.
All right. Thanks, Steve. Thanks, everyone. Before we begin to discuss butterfly spreads, I just want to go over a few quick announcements. Options involve risks and are not suitable for all investors. Please read a copy of the characteristic and risks of standardized options, available at TradeKing.com/ODD. Butterfly spreads are multiple leg option strategies, and these involve additional risks and multiple commissions. So please be sure to evaluate those before trading. And basically, I'm just going to be showing you some examples. These are not any type of endorsement or recommendation. Just want to make you aware of some different ways to consider trading and how butterfly spreads can factor into your portfolio. All right, so without further ado, a few announcements here from TradeKing. You can follow us on many different venues, Twitter and Facebook, YouTube as most notably. So please check us out there, and you can always visit us at TradeKing.com. We also actually just launched a brand new education center, much new content, new strategies. It's TradeKing.com/education. And of course, we have our own webinars. Once we're done here, you can shoot over to our events at 5 p.m. on Tuesdays. Tonight, we're talking about basic charting. So please join us at webinars.tradeking.com. And finally, we are up to the webinar slides. As Steve mentioned, FX options is one of the focuses of the ISE, and I'm glad to be here to share some insight in trading them with you. So right now we're going to talk about butterfly spreads, and these are very flexible trades, and I'd just like to make you aware of some applications that you might not have heard before. As we are talking, or as you see some of the terms that I use within the slides, I just want to put up front some of the meanings in case things get talked about quickly. I want to make sure everyone is on the same page. So please take a moment and review these definitions here. While you're doing that, I'd also like to announce if you would like a copy of today's slides, please send me an email at webinars webinars@TradeKing.com, and I will get you out a PDF of those slides. Again, it's webinars@TradeKing.com. All right, so why do people trade butterfly spreads? Well, there are several reasons, and we are going to highlight 5 of them today. The main reason, though, is to capture time decay. Other reasons involve reducing risk or stopping out losses, but allowing you to remain in the position without closing out the trade. They also provide a cheaper alternative to directional trades, which you may not be aware of, and you can also turn them into a volatility play. And we're going to get into more detail into these items. But before we do that, let's talk about what a butterfly spread actually is. I just want to make sure we're all coming from the same place of understanding, so let's break it down into its parts. And that's the great thing about options. If you don't understand what a strategy is supposed to do, if you break it down into the smaller pieces, you can usually figure out what the strategy is about if you can't recall it from memory. So a butterfly spread is actually 2 spreads together, 2 vertical spreads. And first we're going to look at a call butterfly, or a call fly as I refer to it. And the first part here is the long call spread. So what we're saying here is the underlying is XYZ, and it's 32 days between now and expiration, and you are looking to buy 10 of the 110 calls and sell 10 of the 113 calls. That's a long call spread or a long debit spread, bull call spread, vertical spread. All those terms mean the same thing. And this debit here would cost you is $2. That's one side of the butterfly spread. The other side is the short call spread, or the short vertical, the bear call spread, call credit spread. And in this case, you would sell 10, another set of 10 of the 113 calls, and you would buy 10 of the 116 calls. Okay? And when you do that, that particular side of this strategy, the short call spread, would give you a credit of $1.55. When you bring those 2 spreads together, that forms the call fly, which is buying 10 of the 110 calls, selling 20 of the 113 calls, and buying 10 of the 116 calls. That is for a debit of 45 cents. And that is the most that you can lose when placing this trade, plus commissions. To determine how much you can make in this trade, you would take the difference between the strikes, and in this case they are symmetrical, so the difference between the 110 and 113 strikes is $3, and the difference between the 113 and 116 strikes is also $3. And so that's what I mean by symmetrical. When you take that $3 and you subtract out the debit of 45 cents, you are left with a maximum potential gain of $2.55 per contract per share. So if you're doing 10, the maximum risk here would be 45 cents times 10 times 100, which would be $450, and the maximum gain would be about $2,500. Again, you need to include commissions when making these considerations. I see that Tina here has a question about spreads and calls and puts. I'm going to hold off on that, but I will be certain to answer it. It's a great question. Thank you, Tina. All right, so here is a visual depiction of the math that I just explained. And you can see that the 45 cents, or the loss area, is below the 0 line here. And it's rather narrow. You could only lose 45 cents, but the profit area is somewhat steep. You can make $2.55. However, the area here is quite narrow, as you can see. It's between the break-even points of 110.45 and 115.55. And this is typically how a butterfly spread sets up when you plot the profit and loss graph. Let's take a look at a put butterfly spread, and it's basically the same construction as the call fly, even using the same strikes. We're still using the 110s, the 113s, the 113s, and the 116s. And when you put all that together, again, the debit actually comes out to the same price, in this case 45 cents. This is not unusual. If you look at a call fly and a put fly together, often they will be right around the same price, maybe off by a few pennies. And so this has the same maximum risk and maximum reward. 45 cents or 45-cent debit is how much you can lose, and how much you can gain is a factor of the difference between the strikes less that debit. So that would be about $2.55 per contract. And don't forget about the commissions. Again, the visual shows the same story as we saw before. And so, you know, when you see this, the question I get is, well, what's the difference between a call fly and a put fly? There isn't much difference at all. The takeaway here is, with options in general, but we're talking about butterflies specifically, it's more important which strikes you use, the numbers, you know, the 113, the 110, the 116. That is far more important than if you are using calls or puts. So, you know, please keep that in mind. It's not so much is it a call fly or a put fly. All right then, so let's get to the reasons of why people trade butterflies. The main reason that people trade butterflies is to capture time decay. But what does that really mean? It means that you're placing a trade that's going to take advantage of the passage of time. Options, as you probably are well aware, lose value as each day passes. And so if you can construct a trade that takes advantage of this, that's called capturing time decay. Now, I apologize. Sometimes the PowerPoint functionality doesn't work the best with WebEx. So let's pretend that you can't see the full chart here, and let's just focus on the parts that I will be highlighting for you. All right, so if you put on this trade, and the value was 45-cent debit, right, or $450 per 10-contract trade, and that was 32 days to expiration. As that first week, just about that first week passes, the value becomes approximately $480, assuming that the underlying stays around the 113 level where it was when we put the trade on, okay? Now, not all that exciting. Your trade is up $30. That's great, but you know, that's not even going to cover your commissions possibly. All right, let's keep going. So another 7 days goes by, goes from 28 to 21 days, and now the value has grown to $520. Again, this is improving, but let's continue on. Another 7 days goes by. Right now we're 2 weeks before expiration, and your trade that was $450 when you put it on is now $570. It's worth $570. Okay. Well, what does that mean? That means that the spread that you purchased for 45 cents has now become worth 57 cents. Okay, when you're looking at the bid-ask spreads of the options, and you're figuring out what the butterfly is worth, or you're looking at your options holdings page or your trade calculator, whichever you're using here, the value has gone from 45 cents to 57 cents. Okay, so we're talking about an increase of 12 cents. Now, 12 cents is not a lot of money. However, when you look at when you compare it to how much you're actually paying, right? You're saying 12 cents on 45 cents. Well, that's like 25% return in a few weeks' time. That sounds great to me when you look at it that way, right? And if you can do this with any type of regularity or on any type of repeating basis, this trade becomes really, really attractive, okay? So even though people often focus on the butterfly spread and how much money you can make, you know, that maximum $2.55 that I showed you, that's really not the best way to approach it. Because as you saw, it's really hard to hit that point, that 255, okay? And if you'd like more on the probabilities and how that all works together, I did a couple of webinars for the ISE on comparing butterflies and condors. I would highly suggest you check out those archives on the ISE platform for more information. You can also visit us at TradeKing.com/education, and we have similar versions of those webinars as well on our site. So what I want to point out here is that 12 cents may not be all that exciting, but when you look at it and being 25% return on a trade in a couple of weeks' time, it's really something to consider. If you can hang on for another 7 days, it'll get to $670, which is even nicer. Now you're approaching the 50% mark. And then 7 days from here, it just takes off like a shot up to $2,500. But like we said, you know, that is highly unlikely to happen. You really want to focus down in here where the probability is much better to hit on that trade. But this is basically everything that we're talking about for trying to capture time decay. As the stock or the underlying or the currency sits at the 113 level, which is the same on purpose as the short strikes that you have in the position, those options decay faster than the two options you own, and that overall makes the value of the butterfly increase and therefore makes it profitable for you to sell it and then lock in that gain into your account. I can keep talking while it's loading up. It might be a good time to answer that question from Tina.
Oh, I think
it looks like it's trying to restart here.
Unbelievable.
I'm getting back in now.
Okay.
I just hit join. You might need to promote me again.
Oh, yes. Okay, sorry about that.
No problem. I don't know if I'm in yet. I apologize to everyone. Sorry about that. Looks like I am in. It's resetting something.
I see it. Okay, good.
Steve, do I need to call back? It says the audio broadcast was disconnected.
Can everybody hear Nicole? It looks like you're in twice, but if you can drive the slides and we can hear you, then it's fine.
Okay.
Can everybody hear Nicole? Looks like we're good. Just do a sound check, Nicole.
Okay, I think so. Thank you, David. Okay, so Tina had asked a question that got zeroed out. I want to make sure that I remember what she's asking. And basically the question was something to the effect of, do market makers trade individual options, or do they prefer to trade spreads? And will they trade a spread if you submit a spread to the marketplace? I may not have gotten that exactly correct, but I think I understand the spirit of the question. So basically, when you send your order into the marketplace, depending on what option you're trading, if it's a heavily traded option, you have a higher likelihood that you will be trading against another investor such as yourself. And so, but if you're trading one that's not as heavily traded, most likely you'll be trading with a market maker or a professional of some kind. So, since that is the more likely scenario, that you'll be trading against a professional, and I don't mean against as in a competitive sense, I just mean that that's probably the person who's going to take the other side of your trade. The other person trading with you is inclined to give you good service, if you will, because that person can't make a living unless you come back and trade again, or someone like you. So the more people that come to trade, the better it is for the market maker. And also, the more people that come to trade, the better it is for the retail investor, because then there is more competition, there are more participants, and so on. The market maker will trade against whatever order you put up, and if not make the trade instantly, you will see a price that the market maker is willing to trade a certain strategy for. If you go with a single option, then that would probably be executed in somewhat of an automatic fashion. If you trade a spread, sometimes that can also be handled in an automatic fashion. But market makers do prefer to trade spreads than to trade single options. And the reason is because spreads involve less risk than single leg options do most of the time. There are some exceptions, but we're not going to get into those here. So the question is, will the market maker trade the spread if you submit it? The answer is definitely yes. And actually, it is preferred. So it's usually better for you to submit orders on spreads than it is to submit orders on just single leg options. Tina, if I didn't address the question as you liked, just please repost it and I'll be sure to get to it. David has a good question here. He says, well, if you can make $2,500 in this butterfly spread, why not just hold out till expiration to make the $2,500? That's all well and good. Yes, you can make $2,500. The issue is, though, that the likelihood of making it is significantly low. It is very, very low. Okay, so options is not just about how much you can make. You're also always concerned about what is the probability of making that money. And that's why we go with the odds here. And the odds are that you're going to keep that money if you are in the range of before expiration. The reason being because the options, when you enter the week of expiration, that's also known as gamma week, and options will fluctuate in value much more quickly than they will prior to that week on average. And so if you can take the smaller gain on a regular basis, you're going to do much better than if you try and hold out and hit the home run and capture the 2,500. It's going to be it's going to be easier for you to replicate capturing a smaller gain down in here than trying to capture the gain here. Most likely what's going to happen is you're going to end up with nothing and take the full loss of the 45 cents.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.